Hello, Warriors. Everyone ready for the Consumer Pain Index, Consumer Pleasure Index? Well,
Sorry,
what,
this is the consumer pain index just kills
You
me
like
every
that
time,
one?
Dale. It
You
does.
like
It gets
that,
me every time.
all right, maybe it'll be less painful today, so we'll see. And we have a nice recovery going on in USD yen. Kman bounce and Blake. It looks like it went right to your that 50-day. What you were looking for yesterday to cover before the bounce.
Blake, right? Blake covered
on the button.
Blake covered his shorts right there.
Nice.
I went a little bit long, so both doing okay.
Okay. So we had a little 3 drive here, maybe in the S&Ps. We did diverge before we stabilized. If we get back over and close over 3,900, don't be bearish.
That's it.
Yeah, that's a line.
38.39.
Yeah, right there, 3,900 and
no, I mean
euro.
The range for strength or panic is 3,800, 3,900, right? At the around the close today.
Yeah, I'm just saying it would get
3,800. Something's wrong, right?
Yeah, there'd be a problem. 3,800. That then there's maybe nothing for another 100 handles.
Yeah.
So everything's kind of like in 100 handles. So we get under 38, maybe. Well, we could go for this 37.5, and then here's 37, and then here's 36. But don't rule out the fact that what turned out to be a crisis may also work in the benefit of the market because of what's happened to yields. Okay, and I know a lot depends on what the Fed does, but it's possible that this could light everything up. Because
what I was saying in the room as well this morning, if we get a mild CPI and considering the small regional bank stuff, the most pain is behind us, we could see a very, very big risk rebound this afternoon if we get a mild CPI.
Yeah, and I don't know if this is a top in gold. I guess you could call it a failing rally, but even though silver outperformed yesterday, it's still really lagging. Here's the gold silver ratio. It's back up again. So tough call to know what to do from here in the metals. And someone was asking about Aussie this morning. I think Aussie has some more upside. I mean, of course, a lot has to do with the number, but why can't we rally, even if it's a bear market rally, back to 69? Especially if what you just said, Kman, occurs and risk comes back.
Yeah, if because I mean everything is. I think we really should go into this CPI with an open mind. So if it's a mild one, I can see quite a nice risk recovery. If in turn we get like sticky or higher than expected, then it's probably going to be a little bit panic stations and the dollar rally, I guess.
Any views on the euro here, Kman? Do you think we're headed for new highs, or do you think that
euro dollar zero, but euro crosses I have a lot of views. I think we are already in pre-ECB mode, because we've got ECB on Thursday. The euro dollar is all about interest rate differentials, and we have seen them come off dramatically on the SVB fallout and then correcting right now. Yeah, it's stronger. I think some of the strength has already to do with the expectations of the ECB. Bit of rumors last night or yesterday saying that they would still cling on to the 50 BPs come Thursday. But yeah, I mean, it's a tough one to call on the euro dollar. Get above 108. I mean, then probably people will say, all right, now we're going back to 110, but then we're hanging around in my opinion, pretty neutral, right? In the middle of the range, in the middle of the latest range. Low 105s, 110, 107 and a half is the low. So in the middle. So it's the middle of the range. Euro dollar, at least for me, is a tough call.
Yeah. I'm actually thinking of, if we rally into this ECB without making new highs, to maybe attempt a short above 108, make 108.50. I'm wrong over the high. So that's just, something that I'm thinking about doing. That would take the dollar, and that's based upon, the dollar looks heavy, and, talked about the pound not getting too bared up on the pound down here, and we've had a nice rally. And someone who looks for stops, you would think that maybe we're going to go for, we never took out the stops here from this high here, that we're going to 24 and a half, and that looks like it has a better shot for new highs than this. But yeah, I'm thinking that this was just part one of the dollar recovery, and then maybe around here in this level we get something like this from here that could take it up to 107, 108, because I know people forget about it, and I do too. I'm longer term bearish to dollar, but this monthly that we had here last month, even though we're starting off this month halfway through lower, I still think that this candle, well, like your monthly off number is going to be 101.70. So that's a question. Is the dollar bad and we're just going to take out par, or is this going to be a pullback to buy in here? And we, maybe Greg is here, that this could be A and we get a B and then we get some type of C. Are you here, Greg? Or you were just on Skype?
He's not around.
Okay. Who else is around? Stel?
I'm here.
Metals?
Hello.
Metals, decent.
Well, it was a big day yesterday, but
can't get
CPI,
through 22. Yeah.
Yeah, we stopped at 22. CPI today is obviously going to be very important. I maintain the view that we're going to see CPI year on year starting to drop. I thought it would start from last month, but really we're replacing now high percentage months with lower percentage months. So mathematically, this should be dropping. But the question is, what does the market do? If we're expecting 6% year on year, if it's plus or minus 0.1, 0.2, I don't think anything's going to happen. If it's more than that, then if it's softer than that, so if it's say 5, 6 or something like that, that's a significant move from the previous print, and that combined with the market uncertainty, I think is going to have a big effect on the Fed. Will they pause? I don't think so, but I think they'll do a 25 and change the wording and be more on the cautious side, and this obviously is going to be good for metals risk, pretty much everything, because the market has been trying to gauge for a while now when does the Fed stop? What's the terminal level and how long do they stay there? Regarding the whole regional bank crisis, I don't think I don't think it's over yet. The worst may be behind us, like Kman said, but I don't have the knowledge. I really don't know what these other banks like or the other
Republic.
Yeah, exactly.
One,
I mean, that was down 70% yesterday. Now it's up 45% pre-market. I mean, who knows what they have, what they hold, what kind of hedging they've done? I don't know. So I can't take a view. But what I can do is, based on past experience, these kinds of I don't want to call it a crisis, but these kinds of situations, they very rarely resolve themselves quickly without contagion. So there's going to be, probably a few more incidents, but the way the Fed has handled this, whereby stockholders, bondholders, well, they get they get nothing, but deposits gets guaranteed. So they kind of prevent disaster, or contagion going into, making a bigger problem. So
did the Fed just promise to backstop all deposits, not just that bank? Okay, all
I don't know.
deposits in all banks over the SIPC. Did they just say they're backstopping all deposits everywhere?
They haven't said that, but they've created a precedent, right?
They may have to, because a lot of the people at SVB are contributors to the Democratic Party, to Joe Biden, and they're going to have some political problems if they just stop with these guys that are allies of the party in power. So I think they just said, your money's safe. If you have $1 million or 10 million in the bank, it's safe. I think they're backstopping the whole banking system. That's the way it sounds to me. And that would be pretty inflationary, wouldn't it?
Well, yeah, I mean, when the government starts meddling, they have to keep meddling more and more. And that's the problem. That's the problem, with it all started in 2008. And, why bail out banks and not bail out, a company that makes, shoes?
Why not bail out all of our subscribers that made bad bond trades over the last couple of years?
Yeah.
Anyway, fill up our accounts.
It's a good question, and it's a long discussion, I think. But to come back to markets, we have the CPI today, and I really think that a weak number is going to make a difference. And I know we talk about the Fed's credibility, and they don't want to be seeing flip-flopping and doing this and then changing and back and forth. But I've said this before, I'll say it again. I think they will always choose to bring confidence and support the market when things look like they're going bad. And that's, I think, what they're going to do this time. If CPI drops, that gives them further ammunition to do that. But really, if the situation with the banks continues and it doesn't look like things are resolved, then I think that's going to influence the meeting next week. Sorry, is it next week or this week?
Yeah, next week.
Next week, yeah. ECB this week, Fed next week, yeah. I think it's going to influence the meeting next week. I really think that 50 is out of the question now. I think they're probably going to do 25 and, try to reassure the market, etc., etc. But let's see, CPI is going to be important.
And hey guys, good morning. And you said the kind of the magic word there, Stelios. Maybe 50's out the window, but are we going to get 25? There was chatter yesterday about the ECB and that they may still go 50 this week. What are you guys' thoughts about that? And Ryan, I know you were talking about that yesterday as well, but what do you guys like as a team? Let's start with you, Stel. What do you think about the ECB tomorrow?
It's a tough call. Obviously I thought 50 was done up until Friday. Theoretically, the ECB can still go ahead and do a 50. I mean, there's no direct, at least it doesn't seem to be any direct consequence to the European banking sector, although there has been a rumor about Credit Suisse and UBS merging. I don't know if you heard that today.
Oh, wow. No, I did not.
Again, how many years has that one been running?
Yeah, but
well, just somebody just needs to take DB out. Anyway, go ahead.
Yeah, but look at Credit Suisse's stock price in the last months. I mean, that's never been as bad as it's been now. But anyway, what do I think? I think, unfortunately, central banks are going to cave, and I think there's a bigger chance of a 25 for the ECB than a 50. That's what I think.
Wow. Ryan, are you in that camp?
I assign it a 95% chance of a 50, and the 5% wiggle room in case.
Yours is 95. Okay, where's your bid?
What? 98.
Yours is 98.
I'll give you a stop at 99. I don't see them change anything. If they do change something, to me, that will signal that there are some underlying problems we don't know about with all this banking stuff that they're worried about. So yeah, I say they still go at 50.
Okay, well, Kman, what do you think about that?
Base case is still 50 for me.
Okay, look at you, Stelios. You're in the minority.
Well,
you think the ECB is
the ultimate contrarian.
I don't trust central banks. That's my problem.
There you go.
I don't trust
them. It takes two to make a market.
Don't you think the Fed has to at least go 25, or it'll look like they're panicked?
So they'll go 25.
To give the appearance that it's business as usual, they have to do something like that.
I agree with that, Dale. I totally agree.
Okay.
Yeah.
But they cannot not do it. Yeah, and you're exactly right. It's more for optics at this point. I mean, because what's the difference? What is the difference between, a quarter point or no quarter point? I mean, it's not going to make or break the market, but I think it is for optics reasons.
Yeah.
It's a valid point. But you look at like the Euro crosses. I'm just going back to the ECB really quick. And, a couple of you guys are like, I'll call their bluff. It's going to be interesting to watch the Euro. I mean, and you have to, you look at the Euro and the crosses. I mean, the Euro's held up really well. I know, most of you seen the dollar index, and the dollar index actually showed a big reversal yesterday. Well, actually over the last couple of days, but on a day where you would think that the dollar would act better, it didn't, and it got slammed. And you can see the dollar index is getting, pushed down, and that's all really Euro. I mean, the Euro has held up very well. We're above a 38% retracement. We're getting, it's just bid. And we with the ECB this week, and I want to go around the horn and ask you guys this, and Dale, we'll start with you. What do you guys think is the best trade right now? Should we have a weak or strong CPI number? Like, how are you going to play it? Like, Dale, what do you think is going to be the best way to play a weak CPI number if we get it?
I really don't have a plan. This, I don't have a plan for.
You want to react more in this type of situation.
Yeah, and I'm kind of waiting for the Euro. I want to be a seller looking for a failing rally, but we're not at the levels I would try that yet.
Okay. So all right. I'm looking for like 108. That's kind of, you can see that's like shaded area here.
I like
kind of what I'm waiting for
up there.
Maybe we'll get that today. Maybe we'll get some weak data, and you'll see a spike up to 108 and a fail. What you're looking for.
I'm thinking that happens at the ECB if they go 50. Just what I'm thinking.
Got it. Ryan, what are you thinking? I was in the middle of watching the Trade-Off UK, which is just a copycat of the Trade-Off Australia. Just kidding, Ryan. Joking. I was trying to watch that this morning. It was a little, but we were getting started with the show so I couldn't finish the whole show yet. And I was just getting to your plays of the day and didn't see yours. But what are you thinking here? Strong, weak data. How are you going to play it? I mean, you're going to play it via yen. Are you going to play it, with the Euro? What are you going to do?
Well, I'm long a little bit of the S&P. I think perhaps as important as CPI is, this banking stuff is going to overshadow it somewhat. So I'm long a little bit of S&P, a little bit of a gut feeling trade that we may see a bit better risk today. It's going to have to be a big variation in the CPI number, I think, to bring a big move. But I think the focus will quickly switch to what's going on with this banking stuff. And if there's no further problems with that, I can see risk improving today, whatever happens with CPI.
Yeah, I mean, that was the risk yesterday, and I'm totally with you. I mean, that's why I covered my dollar yen yesterday. Not only was it at the 50 DMA, but unless there's going to be a complete collapse in the banking sector, I was like, things tend to settle down, even when you have little scares like this. And we could sit here and argue all day long if that's just like the beginning of the tip of the iceberg or whatever. But as long as things don't continue to escalate, then I think you're right. You're going to see a move here. The S&P reacted well off the 161% extension of the last 2 weeks move. So in case you guys missed that, this is, you can see the high, the low to high. We reacted twice. We hit that and we've bounced. So that's really key support now, is the lows from the last couple of days. Now, let me ask you this: what would change your mind if the S&P, what would change your minds and tell you today that, is there a number out there via CPI where you're like, shoot, I don't want to be long risk now? Ryan?
Me?
Yeah, I'm asking you. Like, you're long S&P. What's going to change your mind?
8% CPI. That's
really?
a stupid number.
Okay. Well, all right. All right.
But I'm not going to trade stupid numbers. I'm going to trade what the price action tells me. And
Sure.
For now, if we're below 38.50 initially, then that says something's changed in the market or something different is going on.
All right. Well, let's since we're probably not going to get 8% CPI, which if we did, I'm going to crap the bed myself. Ryan, what do you think? Ryan, I'm sorry. Kman, what do you think? How are you trading it today?
Well, I think it's going to be a binary event for risk. If you get a high CPI, I think risk is going to get a little knock on the head. And then you'd be looking at probably a bit lower yen crosses, but a higher dollar yen. But then maybe the commodity or the antipodians could suffer a little bit on the cross side or the dollar side. If you get a mild one without really falling out of bed, I think risk should be doing good today. And then I might be looking at catching a few knives in yen crosses, perhaps even sell a bit of Swiss. Being long antipodians looks good. And then probably the S&P is going to go back above 39, 39.20, and may even have a look at 4K again.
Oh, wow. Okay. All right.
It's
okay.
a mild one. You're asking the both ways. So I think it's a relatively binary event, this one, in the short term.
Yeah. Are you in the camp with Ryan, which, by the way, Ryan, I agree with you wholeheartedly. That whatever the data is, even if it's strong data today, let's just say it comes in a little hotter than we expect. I still think that you probably buy stocks on dips here, as long as we're above 3,800. I'm just talking intraday. I don't know if I really want to. I don't know if I trust what's happening in our system enough to be long risk overnight. Yeah. But intraday, I think while we're above 3,800, you buy dips. But Kman, what are you in that camp?
Well, that's what I said. The levels are 3,800, 3,900, and then the market will tell us, the CPI will tell us what to do with it. Yeah. Personally, I think we've run too far on this SVB small regional bank stuff in repricing. So, which makes me lean towards the idea that a mild CPI will see a bigger bounce in risk than a high CPI could see perhaps a fallout in risk, but it's really 60-40. It's not like 90-10 leading one side.
Yeah. All right.
Hey, Blake, that red trend line that you have at the top, that's kind of a downtrend. Oh, okay. I see it's off those highs from 4,200. Okay. The one above is what I was thinking about. All right.
As we were going into this weekend, because I left for
right.
I was leaving Las Vegas over the weekend. Just kidding. That was the triangle that was developing and
right.
Broke lower. I would think, a move right back above here would be bullish. Like Kman said, you could probably, get us back to 4K. This is this is the range, 39 and a quarter. 3,800, and notice how we're mid-range. Whenever you get into, and people who've been listening to me for years know that whenever we get pre-data, something that's going to be important for the market, it's very common to find yourself mid-range, and that's what we're doing right now.
No man's land.
Yeah, we're in no man's land ahead of the data. Chances are we're going to touch the upper or lower end of this range, following the data here in about 6 minutes. So I want to talk to Kman really quick about something. My whole reasoning, well, there's a few reasons why I covered my dollar yen short, but I'm also looking to sell rallies again. And I'm already starting to sell some, and I'm going to be, I'm not in nowhere near the size position I was on this fall over the last few days. But I'm starting to go ahead and, put my feelers out there. Look, I love it when a trade works out for me, when it wasn't for the reason why I'm in the trade. The whole reason why I'm in the trade is I want to play the change of guard, if you will, of the BOJ. Obviously, the dollar yen came under pressure because of yields and the SVB situation. So I kind of look at it all as oh, well, that was just a bonus. So now, because the dollar yen didn't fall the way I wanted it didn't fall for the reasons why I wanted it to fall for. I fell for other reasons. I covered mine up, and I'm looking to reestablish my position on the short side up here. Let me ask you, Kman, since you are, a pretty staunch yen trader, and I'd love to hear Ryan's opinion as well. Do you think that there still is going to be some yen strength moving forward as the BOJ governorship changes hands? What do you think?
And I forgot to talk about it actually on the flow show today. There's supposed to be a deadline tomorrow, the 15th. That's tomorrow, right? Yeah, tomorrow, because we should be knowing results for wage hikes in Japan. So we should have a bit of a hint to know if Ueda can or cannot press buttons to get them out of that tight straitjacket of YCC and everything. So tomorrow may be a bit of an opening to know what is going to happen. So far, what he has said, it's not going to be the big reformer, but we know that once people are in the seat, it may be a bit different. But yeah, to me, he's not looking like he's going to be the big reformer yet. But it's called the Shunto, is the decision on wage hikes, and we should know some of it tomorrow. So that may change the picture a little bit.
Ryan, you have any thoughts on that?
Yeah, I'm pretty much in the same camp. I think it's a tough one. The way he's spoken already, Ueda, suggests that he's going to keep things the same. But when he's in the hot seat, is he going to change it up? Mm-hmm. That is going to be the question indeed. I still think they will be forced to change at some point. They need to get out of this easy policy. Whether they get the data on their side to do so is another question. I dread to think where dollar yen will be if they never use this opportunity to get out.
Right.
I would prefer better levels personally to be short dollar yen. If we get a risk recovery, if all things are sweet and dandy, and we maybe get a move to 138, that'd be something maybe to look at.
Yeah, 138.
Well, we weren't there. We were only there last week.
Oh, don't scare me right now. Okay. Well, here we're just 2 minutes outside of out of the data, the CPI data. What I've got on the left here is the 10-year yield. I mean, look at that fall in yields. Talk about value proposition in the bond market. Everybody was all over that. We've got the dollar index right in the middle, and then we got the S&P over here on the left. I'm going to close that up for just a minute so we can get a little bit broader view of the markets. Let me go ahead and pull up the data flash. This is part of ForexAnalytix, and I'm going to use this 1 minute chance to do this. I didn't get a chance to do this last week, and I just want to say, if you guys haven't checked out the Trader Funding Program, make sure you do so. I want to give a big congratulations to Brian G. He's in our chat room. I talked to him yesterday. He passed an account, and not a small account. Let's just put it that way. We have accounts that go all the way to $500,000 or $1 million if you want to trade our money, all the way down to like 25 grand. What's most important thing about being in the Trader Funding Program is you get included in the ForexAnalytix community, which is a huge benefit. You can see here's our chat rooms, and you can see how active we are throughout the course of the mornings, every day, every single day. So make sure you guys check out the Trader Funding Program so you can be part of our community. And I'm going to pull this over. Stelios, any last words before we go?
No, I'm just happy I can see Mish is here. I'm a huge fan. So
Yes.
right after the numbers, Dale's going to be speaking with her. But yeah, I think we're going to see a miss today on the CPI. That's my gut
All
feeling.
right. Well, let's hope we start to see inflation.
The consumer pain index out in 10 seconds.
Here we go, guys. Heads up. And by the way, this data flash does come with your ForexAnalytix subscription. S&P is coming down.
In line, 6%.
Look at the core number.
5.5 year on year.
5.5.
Yeah, it's the same.
All in line.
Yeah. And the dollar yen spiked all the way up to 134.50 and reversed hard. I literally got triggered at 134.50. I had an order out there from yesterday.
Nice entry, man.
Well, yeah, I mean, I don't know if you guys heard the ding. If you're in the chat room, you already knew that. So I put it out there yesterday afternoon that I had orders out. So yeah, that was interesting.
Just keep in mind,
here comes the S&P's roaring back.
Keep in mind, CPI is still on a downward trend. So this is 0.4% year on year lower than the last print. And this is obviously what the Fed wants to see. They'd love to see a bigger gap lower, but we're still in a downtrend.
Yeah.
Core's a little bit stickier though.
Yep, that's true.
So we moved from worrying about inflation, like we talked about several months ago, to worrying about solvency and growth. Yep. So the narrative is shifting. And what a great time to bring Michelle in during the time of a narrative shift.
Yes. And I'm gonna let you go. I just wanted to say welcome, Mish. Tony said just wanted to let you know, he said, reminder, your F.A.C.E Zoom emails didn't go out this morning. That's on Zoom. It's that has nothing to do with us. Unfortunately, it's not something that we get an opportunity to do. So
I
Mish,
had a hard
welcome.
time
Thanks,
getting
team.
my face to get going this morning.
Yeah, I didn't get mine either, but your face is going. All right, Mish, welcome. And Dale, have a great interview with Mish. I'm going to let you go. Thanks, Kman, Stelios, and Ryan, and the rest of the team. All right, bye-bye.
Nice trading, boss. Hi, Mish. How are you?
Good morning, Dale. I'm good.
Good. It's great to see you. It's amazing how 3.5 months flies, isn't it? I mean, didn't we just talk? So what's top of mind?
Well, when we did talk, and I guess we talked before the year ended, right?
Yeah.
Looking into this year, pretty much I'm getting what I kind of expected, which was the persistent trading range, especially if we look at the SPX, kind of a stock pickers market. Really a lot of obviously lack of credibility with the Fed, although today may help at least save some of the egg on their face that they had given the recent debacle with the banks. And, really at this point, it's still kind of a stock pickers market, and you kind of have to follow the hotter sectors, and they're signaling pretty blatantly what's doing well. I mean, even last week with everything crashing, the NASDAQ held up pretty well. Semiconductors never broke down under the 50-day moving average if you look at SMH. And so people are still believing that growth stocks and particularly AI stocks are going to be the thing no matter what. And we still don't really know how earnings season is going to be as we're going to get into the Q1, but it looks like there's going to be pressure. I still, I'm in the inflation camp. 6% is certainly better than 6.5%, but it's still over 6%. So I think that this is a market of opportunity, and you have to take those opportunities swiftly. If you're looking to accumulate for more of a passive type portfolio, I think that there's some danger there still, but at least it's not nearly as volatile, even though we had some pickup in volatile, as a lot of people feared because of this persistent trading range.
Okay. So is it possible that this whole solvency issue with SVB and mid-sized banks that people are worried about can actually be a boon for the stock market, because look at because of the big fall in yields, it actually, the crisis could be what lights up risk again in things like semis and the NASDAQ that are more affected by rates than most other sectors, growth stocks.
Well, yeah, I would say anything's possible, of course, but the way I look at it is that with yields coming down, you have the risk of it being, and I shouldn't even use the word risk because we're going to use the word risk again, but with yields coming down, you have the benefit of the growth areas continuing to lead. But what we have seen for years is semiconductors and growth stocks leading, and the rest of the sectors that really measure the health of the US economy reluctantly following along, but acting more like a ball of chain. So in order for me to get really optimistic about the market in general and the economy in general, we have to see the retail sector cooperate. We have to see the transportation sector cooperate, and we have to see the Russell 2000 cooperate, which obviously got dragged down tremendously with the banks. So
that started before the SVB. I mean, the Russell, there was one day last week out of nowhere. I mean, most of the market was steady, and IWM was down 24.
And you could look at KRE. Exactly. So let's look at KRE, which is a member of my modern family, right? It's the prodigal son. It's amazing how classically it acts like the Bible parable, because it goes and hoards all the money and then gets into big trouble and then comes back asking for forgiveness. And what was so interesting about KRE, I was writing dailies a couple of weeks ago saying that the regional banks were flashing some kind of warning. Of course, I could never tell you what it was exactly, but it certainly told me that when it comes to the regional banks, something was going on. And that's important. Obviously, we saw how important it is. So yeah, did we get oversold? Yes. Was today's number something to cheer about to a degree? Yes. But I wouldn't get overly cheerful, because again, inflation is still hot. And now the Fed has added pressure because of what happened last week. Even though it wasn't a credit crisis, it was a liquidity crisis, and there is a difference. I do believe that if I was sitting there as Powell, I would be thinking to myself, okay, I've raised the rates, and clearly inflation isn't going up anymore, and it's going down, but not far enough. And I have really, really an important decision to make now. Do I hold it? Do I go 0.25%, which is most likely what they'll do? I don't think they'll go 0.5%. And that's just this month. I mean, people are looking at 1 month at a time. But the truth of the matter is we still have all these other things going on, geopolitical stuff that takes a back burner when we have a bank crisis, but they're still out there. And that's kind of where I don't want to take my eyes off of that ball either.
Okay. Do you think that we are shifting from the narrative being all about inflation to now, at this point, after more than a quadrupling of rates, that it's a year later and the tide is going out, and now we're starting to see who's naked because the tide is going out, and we're finally going to have a stage where we have solvency issues. SVB isn't the only institution that's been long bonds for a year and taken 40% haircuts. Pension funds, etc.
Right. Well,
municipalities.
Somebody sent me an article, and I just want to make sure that I say this correctly. So I'm going to look at my notes here. But Silicon Valley had 185-to-1 debt to asset ratio.
Wow.
So if there's anything to
good
take
leverage.
Right. But look at our own US debt. Maybe we're not at 185-to-1, but it's still really, really high.
130, isn't it?
Yeah. So to your point, Dale, is there ability for some of these stress fractures to turn into bigger cracks? Well, we saw that with a 185-to-1 debt to asset ratio in the banks. We could certainly see that in other places, because I don't think we necessarily have really absorbed the fact that we went from 0 rates up to yields over 4%, so figure 4.5 between 5
in a year.
In a
That's
year.
That's like chemotherapy, radiation, and surgery all in the same day.
Exactly. And so what, we
Shock.
know that what's most important is not necessarily the rates going up, but the rate of change. And it's been dramatic. So again, going back to Powell, that tells me that he probably is well aware of that. I mean, you would think. And he doesn't want to necessarily become more dovish. But it wouldn't be surprising if he's thinking to himself, okay, well, the market is expecting something. Maybe we'll just say, well, we're going to, he always says data dependent, and the labor market's still being super strong. He'll go either one way. He'll either say we're going to hold here and see how things are absorbed at these current levels, or we'll go up another 0.25% and then maybe hold. Whatever he does, quite honestly, I've always felt it was too late. It was more reactive than proactive. And that's just one aspect of the market. Like you're seeing here, the so many of these companies that were so highly leveraged based on basically zero
rates. Yeah.
Right. How can they sustain? And I also thought what was interesting about the bank thing was that a lot of it was funding startups. And so, the labor market, I expect, will change a bit. I think we're going to start to see the unemployment numbers go up more as the year progresses. And I also think that the stagflation narrative that we've talked about is still there. It's just right now, it's hard to really support that, except if you're looking at gold, because oil's come off and the grains have come off. Some of the other commodities were doing really, really well, like steel and copper. Well, they've come off. They're still pretty high. And then, of course, my great barometer, which is sugar, is still really high. So it's almost like you have to wait. You have to buy the dips in the commodities is how I'm looking at it in certain commodities. Okay. And then you just have to kind of wait for, like I said, some kind of a stress fracture to get bigger. And it may not even look like something internal in the US. It could be, like I said, it could be anything going on outside of the US. And there's a lot of stuff going on.
Well, I think Dr. Copper still looks respectable. I mean, I don't see this as being anything but corrective, just basically shaking off the overbought condition more in time than price here. And what's interesting, Mish, is that take a look at this copper chart right here. And then compare it to what I just had up, the semiconductors. Okay, there's copper. Look at that. There's semiconductors.
Right.
So, Dr. Copper is saying don't worry right now. And the semis are saying don't worry. And some interest rate pressure is coming off. I think that we probably have a lot of fear. I think do you think that the public is underinvested in the market? I've heard people say that that the market is very underinvested, and we're not close to levels we were a year ago, way down from levels.
Well, I think it depends on where you're looking, right? So
equities.
No, but I mean, in terms of what public are we talking about here?
Oh, okay.
Yeah, I mean, if you're talking about the passive investor who has their IRAs and their 401s, they're still in them. I talk to people all the time. We don't do IRAs and 401s, obviously, because this is what we do for a living. I think some money has come out to go more into fixed income, which is probably smart if you can lock in. Recently, more at like 4.5. Some people have been able to get 5 in CDs. I think the retail investor has actually come back in the market since January when it looked like everything was safe again. So I don't know. I know hedge funds have been selling into these rallies and some institutional investors have been selling into these rallies. But I don't know if I could say the number of underinvestment is so broad that we have a factor of FOMO coming from that aspect. Do I think there's always going to be FOMO at some point from the retail side? Of course, that's just the nature of the being. And as we know from 2020, there's a lot more people who talk about trading than I had ever heard prior to COVID.
Okay. You have a view on the dollar, Mish? We had this bounce from par and a half to 5.5. We're pulling back here. Do you think that was it? That would be less than a 38% correction from high to low. Or do you think there's another wave left to the upside in the dollar?
I think it went exactly to where we kind of anticipated. Maybe if it had gone over 106, I would have been a little bit more prepared for a bigger rally, but it couldn't even get there. And again, excuse me, there's always the balance between the technicals and the fundamentals. So it got oversold and it bounced. At the same time, you were having a conversation and it looked like a risk play, safety play to go to the dollar. And then, of course, last week, people didn't go to the dollar as a safety play, and they went more to gold and bonds. And so these relationships are still playing out. I still think the dollar is going to go lower, not just for the reasons that we talked about in terms of the U.S. economy, and not necessarily so much faith in that the U.S. can pull off a soft landing here. I think a lot of foreign investors have been selling the dollar or not buying the dollar. I've heard talk in the Middle East that they're selling dollars. You still have the BRICS thing out there. And of course, a decline in dollar is good to a certain point, right? Until you have much less purchasing power with your dollar in a time where we still have a 6% inflation rate. This is why people get so hysterical about numbers. So think about it, right? You could buy less than you certainly were able to buy last year with your dollar. That could even get worse. It's still 6% of an inflation rate, not really all that great. And if you're going into fixed income, you're still not getting the same rate that matches the rate of inflation. So it's
still a negative rate. It's still not a real rate.
Exactly. And so we are precarious at best, which is why I keep going back to a trading range. I can't imagine at this point, I'm not saying forever, but I can't imagine at this point, maybe we're looking at 2025, but I can't imagine at this point why all of a sudden we should get really overly optimistic, especially since the government will always continue to prove. And it just depends on where they spend money, depending on what party it is. It's not like one party spends so much more than the other. They just spend on different things. But sovereign spending is here, not just in the US, but clearly we've seen that globally to protect their economies from falling out of bed.
Do you ascribe to the expression that in a bull market, anything that could go wrong doesn't, and in a bear market, anything that could go wrong does? And does that make you worry about raising the debt limit, where we're going to start running? That's something else that will be coming up in June, where they run out of being able to do extraordinary measures to keep things going. Do you think a self-inflicted wound or a downgrade is possible again?
Like in 2011?
Yeah.
Which was the last time it happened. And of course, what happened? They reversed it. Game again. It's like look over the, it's like going to the Grand Canyon and trying to get that great shot. And then some people, and one time it happens, but very rarely people fall off the cliff. But mostly people go, whoa, and step back. And I think it's kind of like what's going to happen again. We have an election coming up, and with all of the vitriol that happens between the two parties right now and the accusations, I mean, what party wants to be the one in front of an election responsible for a downgrade on the U.S.? I
think some don't care. Anyway, I mean, that is universal.
You're talking about the fringe. You talk about the fringe. I mean, I think for the most part,
all
we
right.
hear about the fringe because the fringe is newsworthy.
They make news. Yeah.
Right. Exactly.
Yeah. Anyway, that's everyone's saying the same thing. There'll be a bunch of theatrics and they'll do it.
Yes.
So
histrionics and politics seem to be synonymous.
Kind of the same people who up until recently said VIX is dead, it doesn't work anymore. And right, I mean, weren't you hearing that? The VIX is dead, VIX doesn't work. Well, it worked.
Exactly.
And there might be more left after, maybe all we do is get a bear market rally. we start getting through these levels at 29, I know people talking 50 for
Well,
a
VIX. Did I send you my Outlook 2023, how to grow your wealth in 2023?
I don't know.
I have to make sure I send it to you then. I mean, it was
Were you talking about Volmageddon? Some people said there could be Volmageddon.
I wasn't that clever.
All right.
But I did talk about volatility and how it was definitely something to keep an eye on. I certainly talked about inflation a lot, and I always felt that gold was probably my top pick in terms of a more passive type investment. When I say passive, I mean that I'm not necessarily looking to sell rallies in gold, more every time I get a substantial dip, buying more. And that's what we've done. So that's our big buy and hold position that we've had. You know, our models are kind of across the board. And it's been interesting to watch what the quant models are doing, because they have bought a lot of streaming stocks. They have bought a lot of semiconductor stocks. They were in industrial metals and are switching more into the miners. You know, from a more discretionary standpoint, I've seen a couple of other interesting trends emerge. And I think it's important to talk about this because it gives you people some places to go. For example, what's becoming bigger and bigger and bigger is streaming of sport events and some live music events. So like, for example, Formula One stock, that had a huge move already this year. Live Nation is looking pretty good. It pulled back with last week. Netflix still doesn't look all that bad. I mean, I don't want to see it break 295. And there's another company called Endeavor Group Holdings, which is in a bullish phase, which also has to do with entertainment and streaming. Another sector we've been long in Boeing and some of the defense areas. Also, the industrials like General Electric. I mean, we've taken some profits because it made such a spectacular move. And so,
do you think this was a good break to buy in GDX in the miners? And I only bring it up because, you know, one of the bearish arguments for mining has been high energy costs, because it costs a lot of money to bring stuff out of the ground. Right. And with what's been happening with WTI, that's got to be another edge for miners, especially for heading into the 60s. So, you know, you have higher gold prices and lower costs going into it. I think the miners are a great area. My personal opinion.
Actually, so talking about, you know, this is what's so interesting is to have spent my entire life as a discretionary trader, but the last several years with all of the developments that we've had for algos that spread everything from NASDAQ All-Stars to sector rotation to alpha to global macro. The global macro quant is saying buy gold miners right now.
Okay, interesting.
And so and in the formula, of course, it takes into account momentum, moving averages, phase, some fundamental stuff as well, relative strength, volume patterns, etc. So if that's the case and it's right, well, that certainly supports what you just said, which is it could be also on the heels of the oil prices. Now, the oil prices, yes, they have been incredibly low, but I've actually been watching natural gas again.
Oh my God. Yeah.
Yeah, I know. Oh my God, right?
Yeah, but yeah, you don't let your husband trade it, do you? Because it's a widowmaker. You can't.
Not for us. Dale, I went
Not to you.
on
All right.
Yeah, but I went on Charles Payne's show at the end of 2020 on Fox, and I said, buy natural gas and buy Scorpio tankers. And he actually looked at me and he said, you're crazy.
Look, we're putting in a higher low. Look, and Mish is pointing it out. Nice little higher low after this. And we had some divergence here on the daily. Yeah. So why can't it rally back to $5? Just be a reversion to the mean, right?
Absolutely. And actually, speaking of that, it did have a mean reversion in momentum when it was making the new low. And then the next day when it gapped up, that's when I started saying, I think natural gas has bottomed. Now, of course, it had an initial move and it's come off, typical natural gas. But I would not necessarily, I think it may have bottomed. Do I feel like it's a huge rush? I mean, you're looking at your chart there. So obviously 3 looks like would be a good place to.
Yeah, that's a daily.
That's a daily.
Yeah,
If
back
you
over
wanted to
3.
get in now, right. So I'm back to, and this is exactly what happened in 2021. I was watching actually natural gas more than I was watching crude oil at the time.
Okay.
Because it got so cheap. So that could be interesting. I mean, there's, at this point right now, like I said, I think that the market, obviously 390 or 3,900 is a great resistance level. It held as support for the first part of the year. Now it's going on as a resistance. I can see here pre-market, it's right up to close to 390. So that's something to look at. I think in the Qs, it just got through 290. So it's back in a bullish phase and it's going to hold. That's interesting. But you got to really, and semiconductors is now back through 240. So yeah, we're gonna rally now. We've got the Fed meeting on the 22nd, and we'll see what happens from there. And of course, the TLTs are back down a little bit. But what's interesting is gold hasn't come off at all.
Yeah.
So there is a segment of the market, besides me, that wants to make sure they're invested in gold, besides the physical gold, obviously the gold futures.
Yeah.
And my advice to people is don't try to trade 20 different things at once. Really focus on just a few things. And you have some really clear numbers. The one great thing about a trading range is that you can pretty much say, I'm going to sell as we get closer to the resistance areas. And I'm going to buy when we get closer to the support areas. And I'm going to stick to the strongest sectors. So that's why semiconductors rule. But if you do not see the follow through in IWM, which has to start by getting back over 180, it's trading at 177 pre-market, then you know that these things are going to be short-lived. And the most difficult market to trade is the trading range type market, because people get frustrated when they don't get the follow through.
Yeah, they want breakouts or breakdowns, and that's not happening. I will say one thing though, Michelle, is that everyone's embraced the trading range narrative now, which makes me think, what it's having me think, that
of course,
soon we're going to come out of the probably both ranges, one first and then followed by the other. But I wanted to show your website where people know where I have it up. And I think I showed your book came up, and
right. There's the daily. So there was my little article about a consumer price, and I think at the there should be the ability to be able to get the report. One of the other areas I've been watching is, obviously I'm back to watching what happens here with China and Vietnam. I mean, they've just stagnated now, but I have had a theory about Vietnam, and it was kind of my theory about Greece. Remember, we talked about Greece as the sleeper trade, and Greece went from like 24 up to 32. So it's taking a while, but I kind of, even though Vietnam and Greece are very small countries, both of them, but Vietnam being a bit smaller, I do believe that there's an opportunity there, as things that we are so used to as far as cheap goods being manufactured in China. I seeing more labels on clothes that are saying made in Vietnam. So I've been looking there. But anyway, getting back to the website, you can see we have a lot of stuff. What my daily's been trying to do, besides give actionable information, is really using some of our tools and some of our quants, and telling you, like, okay, this would be a good time, like for today, to look at things that maybe had either a bullish compression, which means they didn't come up that much and they've kind of gone sideways during this down move, or a bullish reversal, which is yesterday we started to see a new low with some kind of reversal based on the parameters of high volume, makes a new low, closes in the top 25% of the range, and in what sector that could be, that would make it kind of interesting. Like, for example,
what a move in Bitcoin yesterday from 20,000, huh?
Bitcoin is now up at 26,000.
Yeah, that's so $6,000 in 36 hours.
Yeah, right, exactly. So, I mean, a lot of people still are not trading Bitcoin, obviously, but that took a lot of people by surprise. But when I say reversals in strong areas, this might be a time where it might be interesting to look at something like Intel, because they are involved in the big chip development that we're starting to see in the United States. Obviously NVIDIA, I was kind of hoping NVIDIA would get back down to 200. It didn't. Now that's up a little bit. So yeah, this is still a great trading market, an active trading market. And so I couldn't really tell you we're going to new highs or new lows yet. I still, though, think that I wouldn't necessarily get too complacent with A, like you pointed out, volatility, and B, looking at the idea of inflation, C, looking at the Fed screwing up somehow, looking at the dollar, and finally, really watching the gold as kind of a signal.
Okay. Mish Schneider. Great to have you again, Mish. And, some nice nuggets came out of this today, and a trading range, and semis look good. And take a look at Vietnam. Gold should be a core holding in this environment one way or another. So your intermarket analysis still elite. I appreciate you being with us today. And I root for you and Keith and your team, and hope this is a great spring quarter coming up for you and all your people.
Thank you so much, Dale. And you've been such a great support to us. So we really appreciate you as well. Thank you.
Thank you.
And Blake and Stelios and those guys who are,
Oh, you mean the dream team? Okay,
the
those guys.
Team. Yes, those guys.
All right. Well, thank you, Michelle. Great having you. I'll be in touch with you on Twitter. Good hunting, and great to talk to you. I'm thinking about checking out Santa Fe. I've never been there. I may go there this summer. It's on my It's on my bucket list.
Oh, you'll have a great time. We'll show you around.
All right, Mish. All right. Have a great day.
Take care.
All right, everyone. That's a wrap. You could join the team in 14 minutes on the Morning Edge. Good luck today. Remember, don't just count your pips, count your blessings. Be with everyone tomorrow, and hope everyone is okay from the Consumer Pain Index. See you guys tomorrow. Thanks, Mish.
Thank you, Dale.
Everyone's thanking you.
Thank you, everybody.
All right. Adios. Bye-bye.